A tariff.
Tariff.
Tariffs.
And tariff.
Tariffs.
The first shots at the economic war were fired years ago. But make no mistake, 2025 is the year the world sees the brutal reality of the fallout. This isn't a trade dispute. It's a global conflict fought with tariffs instead of tanks and supply chains as the battlefield. The United States, leading the charge, has so far weathered the counterattacks, its massive economy acting as a shield against the retaliatory blows from its rivals. Yet victory in this kind of war is deceptive. In a war with no clear front lines, who are the real casualties? Can a victory be claimed if it's won atop the ruins of the international system? And is this just one battle, or the beginning of a new permanent era of global economic conflict? Resilience on shaky ground. In mid-2025, the U.S. economy is a walking contradiction. Locked in a multi-front trade war, it has defied predictions of a swift collapse. On the surface, the numbers point to a surprising resilience, fueling a narrative of strategic success. But when you dig a little deeper, the foundation is weaker than it seems. The apparent strength isn't a sign of robust health, but a temporary illusion created by market distortions and a unique economic structure that has, for now, insulated it from the worst consequences of its own policies. Alright, so the story of this win is built on a few key pillars. After the initial shock of early 2025, financial markets have largely stabilized. Consumer sentiment, a critical barometer of economic health, is showing cautious improvement. The fear of a sudden tariff-induced recession seems to have faded from the public mind. This perception is bolstered by a massive fiscal windfall.
On Business Today is from America, and the U.S. Treasury has reported a major jump in customs duty collections for June, pushing total gross tariff revenue past $100 billion in the current fiscal year, a first in American history. In June alone, gross customs duties nearly quadrupled year-on-year to $27.2 billion, driven by President Trump's tariff strategy. Duties have now become the fourth largest federal revenue stream, trailing on individual income tax withholdings, non-withheld receipts, and corporate taxes.
The U.S. Treasury has collected tens of billions of dollars in new customs revenue, a tangible result the administration has spun as a direct financial victory, proof that foreign competitors are footing the bill. But here's the crazy part. Despite warnings that tariffs would send prices soaring, headline inflation was initially contained. Key metrics already decelerated in early 2025, allowing the Federal Reserve to hold off on aggressive interest rate hikes. It's this combination, stable markets, optimistic consumers, a surge in government revenue, and controlled inflation, that forms the basis of the argument that the U.S. is winning. The problem is that narrative is already beginning to unravel. While broad inflation was subdued, the pass-through of tariffs to consumers is becoming undeniable. Economic models now forecast staggering short-run price hikes, 40% for leather goods, 36% for apparel, and over 13% for motor vehicles. And let's be clear, this isn't just a projection. The All Items Consumer Price Index, or CPI, is accelerating, and consumers are reporting that they expect prices for gas, rent, and medical care to rise sharply. The buffer is gone. And then there's the job market, long the bedrock of the U.S. economy. It's showing clear signs of weakening. While the headline unemployment rate remains low, job creation is basically grinding to a halt.
Well, today the Labor Department reported dismal job creation numbers for July and downgraded the jobs creation data from May and June. The president has since fired the head of the Bureau of Labor Statistics. The latest data shows U.S. employers added just 73,000 jobs in July, about 30,000 less than economists had expected.
Projected to slow to a stall speed of just 25,000 to 75,000 jobs per month, barely enough to keep pace with population growth. The number of long-term unemployed is creeping up, a quiet warning that the labor market is becoming less dynamic and more precarious. This domestic weakness is being amplified on the world stage by a declining U.S. dollar. After a period of strength, the dollar has weakened substantially in 2025. Persistent policy uncertainty, a spiraling national debt, and political pressure on the Federal Reserve have combined to erode global investor confidence. The economic engine is sputtering. The initial reading for Q1 2025 GDP showed a contraction, and while a technical rebound is expected, the outlook for the year is one of significant deceleration. The consensus is clear. The tariffs will have a lasting negative effect, permanently shrinking the long-run size of the U.S. economy. So why hasn't it all collapsed yet? The primary reason is something called the pull-forward effect. In late 2024 and early 2025, businesses anticipating the tariffs rushed to import goods and build up massive inventories. This front-loading of economic activity created a temporary artificial buffer. But it's an unsustainable trick that's just kicking the can down the road, setting the stage for a pronounced demand cliff as companies now draw down those stockpiles instead of placing new orders. At the same time, large corporations acted as a shock absorber, eating the initial tariff costs in their profit margins to avoid scaring consumers. Yeah, that phase is over. Companies are now publicly warning of multi-billion-dollar hits and trimming their forecasts. Those costs are about to be passed on one way or another. Finally, the U.S. economy's sheer structure provides some insulation. Dominated by a massive services sector, healthcare, finance, etc., it's less vulnerable to tariffs on physical goods than a manufacturing-heavy economy would be. But these buffers are temporary. The current resilience rests on a fragile foundation where consumer optimism is dangerously misaligned with the defensive crouch of the corporate world. Retaliation and realignment. The shockwaves from Washington's policies have spread across the globe, triggering a cascade of retaliation, strategic realignment, and painful economic adjustments. This isn't just an American story. It's a global crisis. China, the primary target, has been hit hard. The trade war is compounding an already existing structural slowdown, and the economic pain is severe. With U.S. tariff rates on many Chinese goods soaring into triple digits, direct bilateral trade has collapsed. Goldman Sachs research estimates the conflict will slash China's real GDP by 2.6 percentage points, a massive hit that has forced forecasters to cut growth projections to just 4%. For its part, Beijing has deployed a multi-pronged strategy. It has hit back with its own punishing retaliatory tariffs, ramped up domestic stimulus, and is aggressively rerouting its exports to other markets, especially the European Union. What's more, it is using other countries, notably Vietnam and Mexico, as transshipment hubs to obscure the origin of its goods and bypass U.S. duties. The trade war has solidified Beijing's belief that it must pivot toward greater domestic consumption and technological self-sufficiency, reducing its vulnerability to outside pressure. Canada has also been caught in the crossfire.
Today I'm announcing that the Government of Canada will be responding by matching the U.S. approach, with 25% tariffs on all vehicles imported from the United States that are not compliant with CUSMA, our North American Free Trade Agreement.
Ottawa hit back with its own retaliatory tariffs on a wide array of American products, a clear signal that it would not be a passive victim. But the hard truth is, the economic reality is one of profound asymmetry. The Canadian economy is deeply dependent on the U.S. market, and the consequences have been disproportionately damaging. Forecasts project a severe contraction, with GDP potentially falling by over 4%, which would push the country into recession and cost hundreds of thousands of jobs. The pain is felt most acutely in Ontario, Canada's manufacturing heartland. This painful reality has forced Ottawa to back down, declining to match the latest round of U.S. tariff hikes, a tacit admission of its limited leverage in a prolonged economic war with its giant neighbor. This has put other nations between a rock and a hard place. The European Union is trapped in a precarious dilemma, facing the direct threat of U.S. tariffs on one side and a flood of diverted Chinese exports on the other. It is being forced into a two-front economic war, preparing for tense negotiations with Washington, while contemplating its own protectionist measures against Beijing. Mexico is walking an even finer tightrope. As a member of the USMCA and a prime destination for companies nearshoring out of Asia, it's a major beneficiary of the chaos. But its role as a backdoor for Chinese goods has drawn intense scrutiny and anger from Washington, which has threatened Mexico with its own steep tariffs. This has forced the Mexican government into a delicate dance of diplomacy and de-escalation. For the nations of Southeast Asia, the trade war is a high-stakes gamble. They are attracting a historic wave of investment from companies fleeing China, but many of these same nations, including Vietnam and the Philippines, have been hit with U.S. tariffs themselves. They are being pressured to choose a side in a conflict where the United States, with its unpredictable policies, is increasingly seen as an unreliable partner. The world is fracturing, and every nation is being forced to make a difficult choice. Forging a fractured world. This conflict is doing more than just causing short-term pain. It's permanently redrawing the map of global commerce. We are witnessing the rise of a new, more fragmented and politically charged era of international trade. Out of the chaos, new manufacturing hubs are springing up. Vietnam has emerged as a primary winner, capitalizing on its low labor costs and strategic location to capture production fleeing China. India is being cultivated by the U.S. as a long-term strategic alternative, attracting significant investment in its electronics and pharmaceutical sectors. And closer to home, Mexico has solidified its position as the undisputed powerhouse of nearshoring. Its role as a critical hub in an integrated North American manufacturing ecosystem expanding by the day. But here's the catch. This new landscape is being shaped by a unique and purely transactional brand of deal-making. A major trade deal announced with Japan saw it avoid a threatened 25% tariff in exchange for opening its markets, and bizarrely, a vague and unconfirmed commitment to a $550 billion investment in the U.S., from which the White House claimed it would receive 90% of the profits. The details remain opaque, shocker, a clear sign that the deal was more about securing a political headline than fostering free trade. A similar pattern emerged in a deal with the Philippines, where a minor tariff concession was traded for geopolitical alignment against China. The quiet part they're not saying out loud is that this strategy is systematically dismantling the multilateral rules-based trading system. In its place, a hub-and-spoke model is being constructed, with the United States at the center, forcing every other nation to negotiate bilaterally. This maximizes American leverage but erodes the predictability and stability of global trade, replacing rules with raw power. And just when you thought it couldn't get more tense, the endgame is unfolding. The administration's entire strategy has been driven by self-imposed deadlines used to exert maximum pressure. Now, as the focus shifts to the next phase, all signals point toward an imminent and significant tariff escalation. This new wave of duties is expected to target key partners, including Canada, with substantially higher rates. It's a doubling down on economic warfare that ensures the volatility and uncertainty of the past year will not only continue, but intensify. The very policy aimed at crippling one rival, China, is unintentionally seeding the growth of several new ones, a dynamic that could ultimately weaken America's relative global position in the long run. The price of victory. The state of the global economy in mid-2025 is the direct result of a U.S. strategy that has prioritized unilateral confrontation. The result is a paradox, an American economy that appears resilient but is rotting from within, and a global order that is fracturing into hostile competing blocs. Look, if you're just keeping score in a trade war, the U.S. has achieved a fragile triumph. It has inflicted significant damage on its targets while its own economy has, so far, weathered the storm. This has created a powerful narrative of victory. But this narrative masks the deep and accumulating long-term costs. For the U.S., the bottom line is that the tariffs will permanently lower economic potential, reduce employment, and act as a persistent tax on American households. For the world, the strategy has shattered the credibility of the international trading order, replacing it with a volatile system of power politics and sowing deep mistrust among even the closest allies. The final verdict is pretty chilling. At the end of the day, the United States is winning only if the goal is the short-term infliction of economic pain on others. By every meaningful measure of long-term prosperity and influence, the tariff war is a self-defeating strategy. The real test is not whether the U.S. can withstand the initial shock, but whether it can thrive in the fragmented, distrustful world it is helping to create. The evidence from 2025 strongly suggests that while the U.S. may be winning the battle for now, the ultimate price of this victory is one the entire world will be paying for a long, long time. A defiant economy, a fractured globe, the U.S. has proven it can survive a trade war, for now. But what is the real cost of this victory, and who will ultimately pay the price? Let us know in the comments, smash that like button, and subscribe for more.